Inflation has been the big issue this year, and with my specialty being interest rates, I've naturally been all over this during our regular morning trading live streams. What can I say? We've had some fun trading this year. Although beating the dead horse and selling treasuries every day is getting a little old. We did move up today, so hey, maybe things are changing. But this all just begs the question, how much longer can this inflation last? October's consumer price index report once again surprised markets with higher than expected inflation. So what is going on here? Will the Federal Reserve ever get inflation under control? So it's time for a deep find. Let's look at the data and see if it gives us any hints as to what's next. One of the most widely watched measures of inflation is the Consumer Price Index, which is released monthly by the Bureau of Labor Statistics. In addition to the headline CPI number, they also have a core CPI number. This number reflects inflation with food and energy taken out, as they tend to be more volatile components. The Federal Reserve pays particular attention to this core number as it tends to be more indicative of where inflation is going in the long run. Now, within that CPI report, they also split things up by categories, and one of the most heavily weighted categories of core inflation is the shelter component, which has just been on fire lately, with October's reading coming in at 0.7% month over month. But there's a big problem with this component of CPI. It's kind of slow. In fact, the BLS is already discussing changing it. So shelter inflation is calculated primarily from a metric called owner equivalent rents. They look at rents because people's mortgages don't change from month to month, so it wouldn't make sense to use new home prices for this metric. So they actually go to these rental units and survey how much the residents are paying in rent and utilities. Problem is that rents don't change very quickly either. It's only going to change when the lease gets renewed or there's a new tenant. In other words, the metric is lagged, and this lag is very apparent when you compare owner equivalent rents to metrics from private companies that tend to be a little faster, like Zillow's Observed Rent Index, or ZORI, which looks at asking rents. So I actually did a little bit of work in R here and made a chart for you so that you can see here. Now, I understand that all of this technical data about how the metric is computed might make your eyes glaze over, but here's the important part to pay attention to. Because if you look at a chart of ZORI, it suggests that the pace of rent increases has already peaked, suggesting that we should see a similar peak in the owner equivalent rents and therefore more tame CPI numbers. So is that it? CPI is peaking and a Fed pivot can't be far behind? But I can already hear you asking, haven't we fallen for this peak inflation narrative before? So there are a couple of things about all of this that I think we should note. We are talking about different measures that each have their own nuances, and it's just not quite as simple as one being a lagged version of the other. I think that landlords might have gone a little ham on those rent increases, and probably few were actually buying at those prices. So these two measures will probably meet in the middle somewhere, as Zillow comes off of its overextended prices and owner equivalent rents increasingly catches up. And here's the thing, the Fed isn't stupid. I mean, yeah, they did make mistakes at basically every turn, but a large part of that is that the Fed has to weigh different risks. For instance, they put off raising rates earlier because of the risk of further waves of coronavirus, a risk that we now realize in retrospect was probably overestimated. This is why the Federal Reserve decisions are discretionary. They can use any data that they want to make their decisions, and they are well aware of measures like the Zillow index. Like, you watch, I bet you journalists will ask Powell about this at the next press conference in November, and he'll probably say something like, well, we look at many different leading and lagging economic indicators, including alternative measures of inflation, and the Federal Reserve decisions have to weigh the various risks. The Zillow index may suggest that the pace of inflation has already peaked, but it's still pretty high. There's also the jobs market, which is cooling, but still looks very resilient, with unemployment being below the natural rate of unemployment. The Fed is still going to need to see those measures come in line with targeted inflation for multiple reports before they'll feel comfortable relaxing on interest rates. Meaning that despite all of this information, the Federal Reserve is likely to stick to their guns. They really have no choice, because saying anything even remotely dovish could shift markets and ease financial conditions. That would just leave us in the same situation that we were in back in August that forced the Federal Reserve to jawbone markets lower. They basically can't say anything suggesting a pivot until the exact moment that they pivot. So we'll probably see a 75 basis point hike in November. We'll probably see a 50 basis point hike in December. And at that point, all of the data should be in line for them to ease off and just leave interest rates there. If not, start reducing interest rates in the later part of 2023. And this is exactly what you see the markets pricing in when you look at things like the CME's FedWatch tool. That is, unless something breaks before then, like maybe Japan pulls an Amber Heard or the UK sees a couple more prime ministers. Inflation is difficult to fight, so the Fed is correct that the risks are tilted towards higher inflation. But at the same time, the probabilities are that in trying to fight inflation, we probably cause a recession. But we'll see. Is a recession inevitable? And how would you change how CPI is calculated? Let me know in the comments below. I'd also love to know what you think of this format. I would like to do more videos going over current market research. So if you want to see more videos like this, make sure to give us a like. I will see you guys during the morning live streams every morning at 8:30 Eastern time for our regular trading session. And in the meantime, stay excellent, team.